James, I think if I ever went back to a lender, I'd have a problem with my wardrobe. I'm too used to t-shirts and t-shirts.
It was a big adjustment, I don't have my jacket on right now, but had to get a few.
There was one place I worked where the employee handbook said guys had to suit up every day. And I was like, look, man, you're lucky if we're wearing a collared shirt. This is I don't think this I'll do a button down or a polo, but you're out of luck on the suit thing. I've got one that I wear from my wedding for other people's wedding, and that's about it.
Before we get into what we're going to talk about today, which is some cool stuff, I wanted to preempt the conversation, Marcus, with a question for James, given that he's in the Baltimore area. And about 2 or 3 months, 4 months ago, there was a kerfluffle, news about the appraisal business and investors shifting gears on because of it. What can you bring us up to date on what's going on there? Because so much of what happens in the primary markets obviously is based on the investor's appetite for certain kinds of loans in certain geographic areas. And if they don't want to buy a particular loan, there goes the pricing.
Yeah, exactly. Yeah, we learned that in Maryland the hard way last year when by accident the regulators kind of made foreclosures illegal for a while. So that was fun. But yeah, no. So in Baltimore, there is an ongoing kind of investigation right now into an entity that had done a lot of DSCR lending within a few areas, not just Baltimore, a couple other cities, but Baltimore was one of the biggest. And they went bankrupt, and it turned out there was appraisal fraud involved. And as of right now, most investors that are in the DSCR space have, certainly approached the Baltimore area with some caution, but they haven't fully cut off lending. But a few investors have. A few investors suspended lending for DSCR business in Baltimore. And a couple actually went one step further and made the entire state of Maryland, kind of while they're getting their hands around it, off limits, that for a variety of reasons. But it seems like it's getting better. We don't have any more information, but I guess we're living in interesting times.
Yeah. And Marcus Pauly can handle like state changes like that, but investors turning on and off cities or towns or states.
Yeah, we can great thanks for that. So I mean for the pricing engine wise, we can script rules, state, county, city, down to the census tract ID if you want to like do that as well. Typically census tract ID is used for CRA incentives, but sure. We can definitely exclude as much as we need, as much as the investors would like to, or specific lenders.
Cool.
Cool.
Are you looking forward, Marcus? Are you looking forward to the national event in Las Vegas here in the next month at this point?
Yeah, it's coming up. Yeah, that should be a really good time. There's a lot of, good attendance, good meetings. It's what I really like about the national is that the convention room, sorry, blanking on my words here, especially as I'm on a panel, but the convention room has like every vendor possible there setting up shop. And it's just a great opportunity just for me, even just to walk around to see, who's new, who's out there, what the latest tech is. I've always found that probably one of the more interesting things about going to the actual convention is seeing everyone that's out there. You ping that against like the New York National Secondary, where I think the convention hall is far more sparse and it's more about running from meeting to meeting and meeting your partners and all that. I don't know if that's
Marcus,
how you guys.
Marcus, I hate to be a ghost here. I heard Polly had some big things planned for annual. Anything you can tease at this point?
I think our marketing boss is on the call, so I'm going to deny till I die and say
No,
that
just a
we've got fun
tease,
things
just a
coming.
little like come see us. Yeah.
Yeah, no, we'll have a great meeting space, and we've got a great event. We'll get the notice out there, and we'll of course be in the convention room with our team, showing off our awesome sauce product. Yeah, Robbie, that was a good move there, just sneaking into the white space. There's Samantha. Lots of surprises. Yeah, I know we're remote, but part of me fears Samantha McKendrick. So Try to watch myself. Anyway, um, I'm moderator again for this month's panel, and it's brought to you by Polly. So we're quick intro. We're for our product and pricing engine company. We've got AI and loan trade exchange analytics and APIs, and we've got some great things that we're working on behind the scenes. That'll be out later this year and next year. So with that, I'm going to start this discussion with a hard-hitting question. One of the things that I think for me, it's the most followed event so far this past week, and that would be the start of the 2025-2026 NFL season. So this is more of like an office cultural question, but I don't know, James, like Rob, are you guys in any like fantasy leagues with like customers, clients, colleagues? Has any thoughts on that or any activities with that?
I've pared down my fantasy football to one league. It's just my old college buddies. So I drove up to Philadelphia last 2 weeks ago to do an in-person draft. Came home with a parking ticket. Other than that, everything went well, and I'm happy to report that we won this week. So there you go.
Not for
Rob,
me. I live vicariously through my son and his travails with fantasy football. So nothing direct from me though.
what about you, Rob? Do you ever partake? No, I'm seeing that head shake. I've had I mean, there's some interesting side wagers where, first place is like, there's like typically the monetary prize, but, last place, maybe you show up to work in a Halloween costume or something. But anyway, I digress. For those of you on the call today, if you've got a funny fantasy football team name that's related to mortgage, feel free to ping that to the comments. But anyway, back to actual discussion topics. So big thing, it's coming
And
out.
Marcus, I lost interest in football when they started wearing pads. So that shows how long ago I was interested in the sport.
So what do you follow now?
Uh, the person in front of me, I don't know. No, I shouldn't joke. What amazes me is the amount of control or how sports like NFL is a great example of how it has become a year-round phenomenon. Whether even when after the Super Bowl, oh, we've got the Pro Bowl coming up. Oh, we've got the draft coming up. Oh, we've got the combine coming up. Oh, we've got, and you could go into a sports bar any time of the year, and through the NFL's marketing mechanism, you will see something football on the screen. And I think the NFL as a company has done a stunning job of implementing that. So hats off to the league for that. Um,
Yeah, I was
yeah,
just saying the one thing that's, and I know we're going well off topic here. We'll get off topic in a quick second, but this, it's probably about, well over 10 years now, but just how much data and analytics plays into sports now with, not just like where players need to be in position, but, as a Formula One fan, like tire degradation, like cornering speed, and then even for like cycling, nutrition intervals. Like it's crazy how much science there is into the people who make millions a year playing a kids game. But I'll
and
digress
in
on that
hedging
one.
pipelines,
Yeah,
right?
and hedging pipelines. There we go. Yeah.
Yeah, the granular data.
Yeah. So
Amazing.
starting with U.S. Mortgage interest rates. So I think we are at a 1-year low now, with a 30-year coming in at 6.25, give or take a few basis points. Um, James, I'll start with you on this one. Where do you think this is like? Are people getting ahead of themselves with thinking there's like a huge refi boom that rates are going to keep going down, or what's the general mood? What are you seeing out there?
Yeah, I mean, it certainly is the timely topic. Every once in a while, just for fun, I like to give some of our loan officers a hard time by forwarding them emails they sent me 3 years ago complaining about how horribly priced we were when borrowers were shopping their 3 1/8% interest rate. So what a difference a couple of years makes, right? But no, I mean, I think as we look at where the market is right now and kind of the general direction, today's headline was the Bureau of Labor Statistics did their annual revision to job creation figures, and it was pretty ugly. They subtracted a little over 900,000 jobs from the non-farm payroll data. that follows last year's revision of about 600,000 to the negative. So it's very clear that employers are not certainly on a hiring spree, to say it right there. The research that I've read, good, bad, otherwise, is that rates need to get into the mid to high fives for us to see like a real material shift in the market as a whole. So call it something like 5.5%. And at that level, no borrower is certainly happy to be giving up their 2 7/8 interest rate, but it's certainly a lot more palatable than 7%. So, but I think as well, it's worth noting that lower rates are not necessarily a panacea to all problems that we're seeing in the mortgage and housing market. The data shows that home inventory levels are growing. The state of inventory in most areas of the country is getting better. But as rates decline, certainly more buyers come into the market too. So I think that it's important for lenders to be emphasizing this point. But again, net, most experts that I read seem to think somewhere in the mid fives is really where we need to see to have that kind of refi boom. So I guess we're in the right direction.
Yeah, thanks for that. And then for you, Rob Kessel, same bunch of questions. But to add to that, like, do you think there are other headwinds that we need to be looking out for that maybe we're not seeing in the interest rate space?
Well, I mean, starting with the interest rate space, I think the revision, maybe some of the recent reports, maybe there's more steam behind the Fed moving. And, just to kind of repeat topics we've covered in previous calls, the short end of the curve isn't necessarily setting mortgage rates, right? There's still whatever's happening with deficit spending, with tariffs, et cetera, that can bifurcate what's going on with the front end of the curve and the longer end, the 10-year, which is kind of the reference rate that I think is better to think of when you think about mortgage rates. So there's still that dynamic, watching both the short end and the longer end to see kind of how they shake out and whether that curve steepens or not. And to just, it's always hard going after James, but just to add to one point, I think there's some statistic that 70% of outstanding MBS are somewhat in the 4 or lower coupon handle from just the splurge in 2021 and that refi wave. So clearly there's little mini cliffs as we go down in rate that bring some previous production into refinanceable territory. But the subsidence volume is still in that much lower rate. We need a lot more movement on that front. And again, we're kind of tied to that 10-year, the longer end of the curve that's going to impact that. Those would be my adds to that conversation.
Yeah, I got it. And you made that comment about being tough going after James. And imagine what it's like for me going after you, James, and Rob Christman. Why do you think I moderate these things now? But then with you, Rob Christman, and you've got the widest reach out of, I think, all of us with your interaction with other lenders, loan officers, cap markets people. Like, what are you hearing? What are you seeing?
Retirees, LOs. So there's actually a lot going on, and I'll add on to James and Rob K's comments. The question has come up: what is going to make rates go lower, and why are rates here, and why might they go lower? And since day one in this industry, I was taught that bad news for everybody else is good news for us as an industry. And so we are seeing that. And so we look at the job market, and when you think about the Fed's directives, the Federal Reserve, I oftentimes make the joke in my commentary, gee, what before the Federal Reserve, what did we talk about all day? But the Federal Reserve has certain mandates and certain tools for carrying out its mandates. And one is price stability, aka what's inflation like? And then the second thing is the the overall economy and the jobs picture. And so we have seen volatility not only among those counting those jobs, but also among the jobs numbers themselves. And so the reason rates are down where they are today is because the economy is truly slowing from a jobs perspective. And there wasn't a lot of complaint about the methodology or the actual number that came out Friday in terms of, gee, is this right or is it not? The market looked at it and said, this represents a slowing economy. And talk of recession popped up in my email. Gee, are we going to get into a stagflation environment where the tariffs are driving prices up, but the US economy is slowing down? Are we going to be stagnating out there? What is that going to do to interest rates? And so I think that's tempered the euphoria among originators is, oh my gosh, well, rates are down. That's great. But be careful what you wish for. And if we do have a slowing economy, let's say inflation is stable. Let's say prices are stable. We get the CPI this week. We get the personal consumption expenditures and a week or two out. And let's say inflation is tame. Let's say things are decent there. Then if we are focusing on the employment picture, then we start looking at the weekly jobless claims and what are those numbers telling us about the strength of the jobs market, and why are we losing jobs if we continue to go down this path, and what will that do to rates? So rates could go down, and then you've got, though, to counteract that, you've got this renewed, oh my gosh, are we going to have a government shutdown? We are approaching the October 1st fiscal year beginning, and they're jockeying for budget cuts and so forth and so on, and you've got the Republicans and the Democrats, and you've got factions that are talking about this government shutdown and who's going to play hardball and what's going to happen there. And I'll tell you, if we get into, once again, an uncertain environment where investors are not fully behind whatever security you want to talk about, whether that's treasuries or mortgage-backed securities, then that could drive prices down and rates up, right? So you've got a lot of things going on out there. So it's not all unicorns and rainbows. Hey, we're in the low sixes and maybe we'll get into the high fives. The question is, what's going to push us into the fives, and or what could all this government shutdown talk do, because that's only going to amplify as we approach October 1st. So there's a lot going on rate wise.
Yeah, no, thanks for that. So like on the subject of, the Fed, political uncertainty, market uncertainty, and maybe James, will start with you on this one. Like in terms of like rates coming down, would we have to see something like the Fed starting some form of like MBS purchases again, or like in an aggressive way for that to have a more stable impact to the rate environment, or what are your thoughts on like even the possibility of that?
Yeah, I think when you look at kind of where we are today as a mortgage market and as a country, really, the last time that the Fed did a quantitative easing efforts and really did direct MBS purchases and drove rates down, I think it's fair to say there have been quite a few unintended consequences of that. The lock-in effect that we've been dealing with for quite some time now is a direct manifestation of that. So I think they would be pretty reluctant to get into that space. Now, one never knows as the composition of the Fed changes and the whole works, right? You never say never. But I think that one of the lessons that has been learned from the last couple of years is that the direct purchases of MBS, while it might have been necessary at the time, perhaps good, bad, otherwise, certainly is a very difficult thing to get rid of. So personally, I don't see them doing that anytime soon, just because I think they've been trying to get out of that business and shrink their balance sheet, generally speaking. Certainly that would bring rates lower, no question about it. The old mantra of "don't fight the Fed" would come into play, but I think they would try to avoid that as much as possible, at least barring some kind of an emergency situation.
Yeah, I got it. Thanks for that. And then Rob, Kessel, a question for you with this. With yeah, I think the September rate cuts already priced into the market at this point. Like in terms of like a Fed easing cycle, what would be some advice you'd give on the hedging front as it relates to managing that interest rate risk? And then on top of that, let's take it one step further, and on top of like, what does that mean for ARM pricing? And James, if you have, or Rob Chrisman, thoughts on that as well, happy to kick it back over to you. But both hedging and ARMs.
Yeah, I mean, I think, and Rob Chrisman mentioned it earlier, the key thing always with hedging is don't be complacent. Don't assume the market's going to do anything. There's enough uncertainty and ambiguity in which way mortgage rates will go that notwithstanding what the Fed does, which obviously isn't exactly telegraphing a very clear and concise plan for, anything more than September, if that. And so from a hedging point of view, it's don't be complacent, don't make any assumptions, don't let an assumption creep in to your beliefs about where pricing's going, and just stay the course. That's the hedging mantra. And then from an arms point of view, typically we're looking at 2 10-year spreads. We're looking at the steepness of the curve. The arms are going to be priced out more of the front end of the curve compared to the fixed. So you need more steepness in the curve, a bigger 210 spread to where arms are going to start to be, somewhat more attractive. I think James probably has better data, or you, Marcus, on what kind of arm production we're seeing. Not a ton right now, but that's kind of what we watch as we see the yield curve move around given Fed and market expectations.
Yeah, I would emphasize one thing that Rob just said there in particular is that in my career, just going back to complacency, it's the kind of markets where quote unquote everybody knows what's going to happen. We all know what's going to happen. Oh, we're at the beginning of this. So those are the kind of markets that tend to be the most unexpected when everyone sits around saying, "Oh, we all know what's going to happen," or when I'm having conversations with friends and they're saying, "Oh yeah, I know that the Fed's going to do something," and all of a sudden something happens that is unexpected and it triggers market volatility, and that tends to have the widest range. So I'm always, I'm always a little skeptical when we're in an everybody knows situation, right? Because we've always seen it reverse the other way too. But the only thing I would add to that, just in terms of what lenders are focusing on right now and hedging perhaps in a Fed easing cycle, is when we think about rates trending lower, notwithstanding what I just said about an everybody knows kind of market. If you think about rates trending lower, we're going to start to see more of a normal distribution of purchase and rate term and cash out refis. And candidly, it's probably been a minute since lenders have had a large enough sample size to really calibrate their pull-through models for refinance transactions. So in many cases, my guess is that lender pull-through models are probably a little more dusty than they would prefer. So it's a great idea, of course, again, to be reviewing those assumptions. It's also a good idea to be beginning to prepare management teams for the idea of more volatility in general. Generally speaking, you're going to see more volatility in the range of pull-throughs for refinance transactions too. So given that it's been a couple of years since we've had more of a normal, for lack of a better phrase, distribution of lock purposes in our pipelines, it's probably a good opportunity to be re-educating and re-preparing people accordingly.
Yeah, thanks.
Expectations are important. I know Susie's going to go to the dance with me, and then no, I don't want to go to the dance with you. It's like, holy smokes, get into a tizzy. For everyone, especially as Rob just mentioned, don't try to guess where the market's going to go. I think the last time the Fed cut rates, 30-year rates went up. The question that I'm fielding mostly right now is, why aren't there investors for ARM loans? And ever since I started in this business, Fannie Mae and Freddie Mac have not really fielded a team when it comes to buying arms, and for a variety of reasons. And there's no reason to believe that they would step up in this kind of environment if arms become more and more attractive. The At the Western Secondary last, it was in August. The fellow from Chase said that their pipeline was 70% adjustable rate mortgages. All right, so 70%. That tells me something. It also tells me that probably the other banks, the Wells and the Bank of Americas and the U.S. banks probably aren't much different. So the banks and the credit unions, I think, tend to do very well in an ARM market at the expense of brokers and IMBs. And frankly, those big banks have big bank branch networks which supply them with adjustable rate mortgages. So they're not, if they do have a wholesale channel or a correspondent channel, they really aren't inclined. They don't have to go out and price arms to IMBs and to brokers to get that business. They can see that business coming through their branches. But getting back to what I'm fielding right now in emails is why aren't there buyers out there? Why when will the ARM market see prices from investors of 102, 103, 104? And so I politely tell them that the anytime an investor buys a loan at 103 and the loan pays off 3 months later or 4 months later at par, that company just lost 3 points. That investor just lost 3 points, and you don't make that up on volume. And so when you are trying to be in an ARM market and you're trying to originate, and if you're an originator and you want that 102 or 103 or 104 price, you're probably not going to see that in an ARM world because investors are very wary, not weary, wary of paying a premium for those loans because they just don't want to take the hit. So it's a bank and credit union environment if the yield curve continues to steepen here. So it's always been that way.
Yeah, I got it. And just general question for the group, is there other like business line advantages for banks and credit unions to sell more arms than fixed? I don't know if there's any like other factors for that, or is it strictly a yield curve and internal strategy? Like, I don't know.
I mean, I think if the banks have more flexibility in what they can do with their cost of funds, with having being able to put loans on the balance sheet, the kind of hedging instruments that are available to them. So if they're like competing for business as against IMBs and the market in general, and they have several hundred basis points of rate advantage, even if it's an adjustable rate, just because of what they can do with balance sheet and hedging instruments, that who knows, that's like an avenue for pretty competitive pricing. So that's what I would say. I'd turn it over to James or Rob for your thoughts.
Yeah, I'd echo that. It's a little bit more in a bank's DNA. If you think about what a bank is doing on a daily basis versus an IMB, you have your ALCO committee, you have your commercial portfolio, you have a whole host of adjustable rate products already that you're quite good at, you're very comfortable with, and so on. Whereas IMBs, good, bad, otherwise, tend to be focused a little bit more on fixed rate product. And I think Rob Kessel said it very well, is that is an opportunity for banks and credit unions to differentiate themselves and leverage their strength, which is their balance sheet and cost of funds, versus an IMB that maybe has a different focus.
Yeah, and then actually, James, sorry, let me cut you out there, Rob.
Well, I was going to say people on the call should remember that an independent mortgage bank is borrowing money from a warehouse bank, fund the loan, sell the loan, and then pay off the warehouse bank. And if the warehouse bank is charging an interest rate that's actually higher than the mortgage that the company is originating, you're losing money every day that loan is on the warehouse line. To James's point, deposits, if the bank is paying, and I'm really simplifying this quite a bit, but if the bank is paying depositors, 0 or 0.25% or 0.5%, and using that money to fund originations of ARMs, 3-1s, 5-1s, 7-1s, or whatever they might be, as long as those are 3 or 4 or 5%, that's a 3 or 4 or 5% spread that bank or credit union is earning. Whereas an IMB, if their warehouse bank cost is 4 or 5% and they're originating a loan at 3 or 4%, that's a tough IMB environment. So, and like I said, I'm simplifying that quite a bit, but that's the general gist of things.
Yeah, I got it. So James, actually, I'm going to follow up to something you said earlier with like a more even distribution with production, with like cash out, rate term, and a decent purchase mix and all that. I'll start with you on this one, and then we'll, I guess, go around the horn. But do you foresee hiring to increase in the industry, or is everyone still in such a place where they're like, no, we are kind of at our bare minimum and we don't want to go through that process again? Or what are you seeing on your end? Or is there like a bigger reliance on technology?
Yeah. Yeah, it's a great question. I think that certainly it's worth emphasis at a big picture point of view that so much of a lender's business model is based on capacity modeling, that lenders staff to a certain level of production assumption, and they assume it'll be a little lower, a little higher. They'll pay overtime as needed, on the high side, and only then begin to hire. Where we are in the cycle right now, I have to imagine that there's skepticism about the need to ramp up hiring until we've seen it for a little while. Um, so I really wouldn't imagine, a tremendous zeal to run out and hire. I think that's really where enabling technology, to your point, comes into play, is how can we do a little bit more with less? If you think about the state of the industry 3, 4 years ago, again, very big picture, 3, 4 years ago, we were coming out of the greatest refi boom in history, and lenders were staffed accordingly. They were probably not as efficient as they could have been because, frankly, loans were falling from the trees. But this time is a little bit different, and as we start moving into hopefully a different rate cycle, hopefully a higher production environment, then certainly what we're going to see is, I think, lenders taking the opportunity to say, okay, now that we've gone through some tougher times, now that we've staffed accordingly, what is it that we're going to do differently this time? How are we going to make sure that we're as lean and efficient as we possibly can be? So yeah, I think it's an intersection of staffing and capacity with a technology tailwind on top of it too.
Yeah, I
Yeah,
think
thanks.
if I could add on to that briefly, the it's definitely quality versus quantity. And I think top recruiters, and I'm thinking of one in particular, he he is kind of like the blue blood of recruiters. And I would imagine that the interest out there among potential candidates could be high. It's not like it's not like they've got huge pipelines they may not want to move. A lot of people's pipelines might be small but starting to build, and so they may be looking at a change. But the companies that are out there who are looking to expand, I would say, are much more. We started this discussion talking about science and granularity and so forth. I would say the same thing goes for companies looking at prospective branches or loan officers. It's just not let's throw people at the problem like we were in 2020. Let's take our time and see, maybe this guy, Rob Kessel, yeah, maybe he's got a good branch, but gee, is he originating profitable loans? Or is he always asking for extensions or renegotiations? Or what's his turnover been like? And so forth. And let's really dig into this before we bring Rob's branch on, because we don't want to make a mistake. And we have the tools, we've created the technology tools to bring people like Rob and his branch on, but we want to make sure we're making the right decision here. So we're gonna look at this very carefully.
I'm hoping that everyone is listening to what you just said, Rob. What I would say is that my experience has been is like the distribution of purpose types. I think there's a distribution of originators out there. There's a lot of animal spirits that are, kind of been at bay for quite a while. And my guess is there'll be a certain number of originators that will probably not listen necessarily, Rob, to your suggestions about doing it in the right way and doing it in a conservative way. And that will see some segment of the market probably try and expand quicker, take first jump, try and grab that extra production if there is a kind of refinance or extra volume kind of push, and try and absorb that right away. And it just seems in every one of these cycles, there's a whole continuum of how lenders respond to it, and some with more years of good experience than others. But my guess is we'll see the whole range as if we get into an environment where we got that extra volume coming our way.
I like any discussion that brings up animal spirits. I love
Yeah.
this animal spirits term. I think, Marcus, you should make that a goal for every one of these, somehow work animal spirits into it.
Well, maybe what we do for the next time, for next month, on this blank side of the screen, we all have our spirit animal as part of the graphic, and we can do a round robin of who
That's-
identifies with
I love this.
the emu or whatever.
Hey, Rob, have you ever read Random Walk Down Wall Street?
I don't think I've read the book. I'm a big fan of the Random
Ah,
Walk, but go ahead.
no, it's a you know, it's a book worth reading. It's actually a book that I read early in my investing career, and it's influenced me ever since. So yeah, check it out. A Random Walk Down Wall Street. Sorry,
um,
we're digressing
no,
here, Marcus. Take it
no,
away.
all good. I was going to say back to the spirit animal thing. Years ago, when I used to write a commentary for Opus, I just posed a general question to the whole company: was if we were an aquarium, if Opus Advisors was an aquarium, what part would you play in that aquarium? And the responses between sales, ops, and cap markets got pretty violent by the end of the day. Um, I think one
Sea
LO
slug?
said
Were
we
there any
were.
sea slugs?
Yeah, there was one lobster that said we were the water because without us you'd all drown anyway. Without any, it was it turned into a pretty spirited debate. With the last few minutes here, I do want to switch gears to one last final topic. And last month when we talked about Fannie and Freddie fading, we actually talked a lot about like non-QMs entrance into the airspace and what that meant. Are we seeing anything in like a rise in Govy loans, a rise in non-agency, or are we seeing banks ramp up portfolio lending because of that? And I'll just go around the horn. I'll start with Rob Kessel because you turned your mute off. So I'll start with you.
Well, I'm not, I don't have access to the data that you guys do, but my knowledge, there hasn't been any material spread tightening, agency to non-agency production, and it seems to be super unclear as to how things may shake out with the agencies. Not least of which is what would the capital structure be in the end that would support what GFE, and how that may be influenced by other executive actions and or initiatives. So much is up in the air. It just to me doesn't seem like there's any direction on the spread between agencies and non-agencies doing anything predictable. Let's put it that way.
Yeah, I mean, to me, I'll jump in. I think the interesting thing on my side is the private label securitization side of the house. And for purposes of this, maybe I'll just kind of lump private label securitization and portfolio lending together, just to kind of as non-agency, non-Fannie Freddie. We've seen non-agency bids for agency production increase in popularity, especially where GSE LLPAs are pretty punitive. So a good example being something like a second home or an investment property, or especially combined with a scenario where maybe it's a condo and the borrower's doing a cash out, et cetera. And we can talk about 4 or 5 points of LLPAs. So those cash flow based bids, be it portfolio or PLS, can ultimately be pretty attractive even for an agency product. So I think for lenders, the strategic implication here is just to always be vigilant and to be ensuring that a lender's cohort of investors is sufficiently diversified in terms of their valuation and ultimate end delivery strategy. So, for jumbo loans, for example, does the lender have portfolio buyers as well as investors who are doing private label securitization? For you mentioned non-QM, Marcus. Does non-QM are some of the investors selling to life insurers, or again, are they just securitizing? And those again for those higher LLPA stories, are they working with investors who can provide non-agency bids in some scenarios? So for me, getting to the next level of detail in terms of the valuation methodology underlying an investor's bids is one of the better ways that, if we do see changes at Fannie and Freddie, it's one of the better ways to ensure that a lender's pricing remains competitive in various market environments.
Yeah, Robbie and I were talking to some originators here in Boise yesterday, and they are seeing some non-QM products in the sixes. So the and that immediately leads to a G fee discussion. And we were asking the audience yesterday, what's the lowest G fee that you remember, those of you who have been in the business for a while? And somebody said, I remember 11, like WAMU or somebody was at 11 way back in the day of 2006. And somebody else said they saw a 9 G fee. Well, G fees now aren't they in the 70s?
Yeah, when you
Aren't
include
they?
LLPs.
Yeah.
Yeah.
I mean, so that's a non-QM, or that's a non-QM factor when you look at their rates versus Fannie Mae and Freddie Mac. And you have this whole thing swirling above us of GSE conservatorship and them beefing up their balance sheets and them really, wanting to add to their net worth. And yeah, they're in it to make money. And I think then the question is, well, gee, are they intentionally losing market share to these non-QM private label types? Or is it just, something that just shift, is it just a shift unintentionally? And maybe Fannie Mae and Freddie Mac someday will say, whoa, we don't need to charge 70 basis points or 75, whatever it is. We can start reducing that uh, and get business back. But right now, I think the advantage is going towards the non-QM DSCR types that are out there who don't have those G fees, who may not have some of the price hits that Fannie Mae and Freddie Mac do. Maybe the underwriting is easier. Maybe they're more open to counting income that the agencies are not counting, and that helps the borrowers. So there's a lot going on out there.
Yeah, cool. Thanks for that. Well, that wraps up all the questions I had for you guys for this month, and we're coming up in time anyway. So, James, Rob, and thank you as always for your expertise. And
Mr. Kessel, where are you today?
Southern Florida.
uh,
And how about you, Mr. Kristen?
Boise, Idaho.
Boise, you said that. That's right. Boise, Idaho.
Yeah. I'm looking out the window at the Residence Inn, Marriott Residence Inn. So, yeah. All right. Well, thank you, Marcus, and thank you, Polly.